Hello, everyone, and thank you for attending today. My name is Steven Primo. I am the president and founder of Specialist Trading. And before we begin, I just want to make sure that I'm coming through loud and clear and that you're seeing and hearing everything okay. I have a great presentation for you today where I'm going to give you some very good information. And I just want to make sure that it's coming through all right. All right, great. Looks like everything is fine and copacetic. Let me just close a couple of windows here. And just to make sure, once again, my name is Steven Primo. I'm the president and founder of SpecialistTrading.com, and for those of you who are unfamiliar with my website, we feel we are your premier online source for education in trading virtually all of the markets, and most especially the Forex markets. I've been actually trading for 35 years. Just to give you a little bit of background about myself, I first started out trading on the floor of the Pacific Stock Exchange. I was on the floor for 16 years. 9 of those years I was a specialist for Donaldson, Lufkin, and Jenrette. And I've virtually traded through every market scenario, every market environment, the crash of 1987, the great bull market. So I've seen and heard and traded just about everything there is. So the main thing what I want to focus on is that even though my background is in stocks, and even though I started trading with stocks, and that was really how I learned how to trade, everything that I teach and mentor today can easily be transferred, and I feel even more importantly, transfers over the best onto the Forex markets because they are the best trendy markets available, and everything I teach and trade has to focus on the trend. We really don't try to pick tops and bottoms of specialist trading. I used to trade that way, and trust me, I know it's a recipe for disaster, whereas you can do well for 8 or 9 trades in a row, and then on the 10th trade you'll give everything back. So I really don't feel comfortable, and I don't feel that you'll ultimately be a successful trader trying to pick tops and bottoms. But what we really try to do is find a trend and be in sync with the trend. But many times it's very difficult to find what the trend is. So in today's presentation, I want to talk about and show you one of my best tools that I use and I mentor with my students. And this is really a simple pattern that signals the trend change. Now remember, we're not going to try and use this to trade off of in terms of picking tops or bottoms, but this will really get you in sync so that you really feel comfortable and know where you are within the current trend. So that's what we're going to talk about today. It's extremely simple, and you can start using this as early as today. In fact, I'll give you a couple of clues as to some currency pairs that are currently using this particular pattern. Now, before we start, I just want to make mention that FX Street has provided us with a link to a microsite that gives you more information about my strategies and about my website. So you can either copy this down, or we've actually shorted it for you in yellow at the very bottom. You can copy down this abbreviated link here, and this will take you to our microsite, which is right here for FX Street. It gives you more information about the strategies that we teach and that we market. It gives you a little bit more background about myself as well. So I encourage you, all of you, to go there if you have any questions concerning specialist trading and any of the strategies that I teach and personally trade myself. Just simply click on the course descriptions and I'll take you right there. Now, before we begin, we're required to show you our disclaimer. I'm going to show you some performance results using this particular technique for finding out where the trend change is. But please remember that we can in no way guarantee that any of these results will be repeated in the future. So as you're taking a moment to view our disclaimer, I know a lot of you, I see some names here that were actually have seen my webinars before, but there are some new people here, and I just for the sake of those new people, I like to teach and give presentations a little bit differently. I love questions, I love answering the questions, but it's very difficult in my type of presentations to break up and answer questions while we're in the midst of the webinar. So please, can you ask any questions later on? I promise I will get to them at the very end of the presentation. Any questions that you may have later on, I'll show you that link once again to that microsite at the end of the presentation once again, so you can copy it down. But it kind of breaks up the momentum if you have questions while I'm speaking. So I promise that I will answer each and every question at the very end. And if we happen to run out of time, I'll leave you with once again that link, as well as a phone number and an email address where you can contact us and ask us any questions. Okay? So thank you. I appreciate it very much. And let's start off. I'd like to start off the presentations by showing you something that was in the Los Angeles Times. This is where I live in Los Angeles and trade out of. And this was a year ago, and I've started out many of my presentations this way because I think that it really hits home, and a lot of traders feel this way. It started out by the headline in the business section that said, "The foreign currency trading is easy. It's an easy way to lose money." Whereas more and more Americans are dabbling in currency trading and losing in spectacular fashion. Experts say the structure of the currency market makes it hard for amateurs to beat the house. All right, now, first of all, I actually have to agree with this, even though it kind of goes against everything that I believe with trading. I actually have to believe that it is an easy way to lose money, but not because of the education you're getting or not because of understanding of the markets or the house is arranged against you, the odds are against you. I really don't believe in any of that. Why I feel most traders lose money in the foreign currency markets is because they're getting in their own way. It's really not an outside source. It's really yourself that's getting your own way. I have been, once again, trading for 35 years, and roughly for the past 10 years I've been teaching and mentoring my own personal strategies. And what I see over and over again is traders, it doesn't matter if you're a beginning trader or a seasoned veteran pro, but you're making your trading more complicated than it has to be. And what I mean by complicated is that you're putting too many things on your trading plate. Your trading method or plan is far, far too complicated. You have probably way too many indicators that you can't decide from. You're involved in way too many chat rooms or trading rooms. You're reliant too much on news and trying to decipher what it means. And you're really spinning your own wheels. And I think this is what makes foreign currency trading an easy way to lose money. It's not an outside source. It's really yourself relying on these outside sources to get you successful. And trust me, I know, because when I first started trading, I had a very difficult time on the floor of the exchange, the stock exchange. Why? Because I was doing the exact same thing. I was overcomplicating my trading. And once I started to simplify things, a few specialists taught me how to simplify things, that's when my trading started becoming consistent. So this is really what I try to do with specialist trading. My goal is to teach you the same things that turn my trading around. This is the specialist edge. And really it's rooted in simplicity. So at specialist trading, we're not trying to go for home runs. I'm not trying to promise anyone they're going to make 400% or 500% a year. What I'm trying to do is instill the same things that were taught to me that turned my way of trading around, that'll get you on this road to consistency, because it's really about consistency. Because I don't care how much money you make trading in any market. If you give it all away and if you lose it all, what did it matter? What really matters is longevity. That's the secret to success, and longevity is achieved by this nice consistency in your trading. Not trying to go for home runs, but trying to go for singles. So that's what I teach at Specialist Trading. That's what we teach to all of our students, and that's incorporated in all of my strategies and techniques. All right, so here's what you're going to learn today. Once again, this is a simple but high probability technique for spotting trend changes in the Forex markets. So many traders lose money because they're out of sync with the trend. Remember, I said my philosophy of trading is only trading in sync with the trend. We're not going to try and pick tops and bottoms. Ultimately, that's a recipe for disaster. It will work every once in a while. I know, once again, firsthand. But when it doesn't work, that's where you give it all away. So it's much easier, and you're going to sleep a lot better if you trade in sync with the trend. The only trouble is, one trader's uptrend is another trader's downtrend. So I'm going to show you a real simple, high probability technique for spotting these beginning of these trend changes in the currency pair market. And this can be in any time frame, in any direction. It doesn't have to be simply looking at daily bars. It doesn't have to be looking at monthly bars. It can be virtually any time frame, and I'll show you some examples of that. All right, so here are the indicators you're going to be needing for this particular technique. A 50-period simple moving average. Okay, that's it. We're going to all you need on your screen is a 50-period simple moving average, and that's it. See how simple things are? We're not trying to overcomplicate our trading. So we want to plot a 50-period simple moving average. You can release all the other indicators and take them off your screen. And then we're simply looking for an outside day bar pattern. Okay, that's a simple 2-bar pattern that we're looking for in the particular currency pair we're looking at. Now, for those of you who aren't familiar with what an outside day bar pattern is, let me just spend a few seconds here explaining. Outside days are days where the chart bar is both higher and lower than that of the previous day. Okay, I'll say that again. Outside days are days where the chart bar, doesn't matter if it's a open high-lows close chart bar or if it's a candlestick, it just doesn't matter, just where the chart bar is both higher and lower than that of the previous day. In other words, the range is higher and lower. Here's a perfect example here. These are outside days. Now, if we look here, we see that the second bar in this 2-bar pattern, its range is both higher and lower than the previous day. And we're not concerned with where we close. In these examples, we close at the high and open at the low. And we're not concerned where the open and close is of the previous day. Those are more geared for candlesticks. With outside days, all we're concerned about is the range. So in this 2-bar pattern, the second bar's range must totally be higher and lower than the previous bar. It does not matter where the closes are. Here's another example. Okay, here's an outside day as well. This particular example, we opened higher and closed lower, but it doesn't really matter. These are not candlestick patterns. They're not engulfing patterns. We're not concerned with the open and close of either of the 2 bars. All we're concerned about are the ranges. Therefore, you can use a candlestick to see this pattern. You can use an open, high, low, close bar to see this pattern. It doesn't matter. We're just concerned with the range of the second bar, that it totally exceeds the high and low of the previous bar. Okay, so that's the definition, and those are a few examples of outside day. So we've plotted a 50-period simple moving average, and now we're looking for these outside days. So how is this technique implemented? How are we going to use these 2 different tools here to spot when a trend change is underway? All right, here are the rules. Look for either bar of an outside day pattern, okay? Either bar to touch the 50-period simple moving average. So we want to see either of those bars, either the first bar or the second bar, but one of them has to be touching a 50-period simple moving average. Once we spot that, this is our signal that a short-term trend may be underway. We're not saying it is underway because nothing is guaranteed or nothing is set in stone. This is just a high probability technique for finding it. But I'm sure after I show you these examples, you're going to see how simple and how really high probability, or how this can really help you. All right. So once again, look for either bar of an outside day pattern to touch the 50-period simple moving average, and this should be your signal. There should be like a little green light going off that a trend may be underway. Here's an example of the British pound going back to August. Okay. Now we have the 50-period simple moving average right here, and here's our chart, daily bar chart. Okay. Now we're looking for a 2-bar outside pattern here. That's where the second bar totally exceeds the high and low of the previous bar. Now we haven't found it yet, and as we're looking, remember we have to touch the 50-period simple moving average. As we're looking, we see that's right here. Do you see how the second bar in this pattern, the range is higher and lower than the previous bar? Once again, we don't care where the close or open is, just that the high and low totally exceeds the previous bar. And we also, at the same time, the second bar touched the 50-period simple moving average. Doesn't matter if it was the first bar or the second bar. In this case, it's the second. But just one of those has to touch. And then look what happened. 550 pips to the upside. Okay? That little clue right there, not a trading room or a chat room or some guru that you listen to on TV or some economic report, but just this simple clue that the market was giving you, that a bar chart was giving you, signaled that there was a strong trend underway in the British pound. This was just a couple of months ago. How about the euro dollar? Okay, let's look back to May now. The euro dollar, once again, we're looking at daily bar charts. We have the 50-period simple moving average, and we have our standard bar charts here. I know a lot of Forex traders like to use candlesticks, and that's fine. You can use candlesticks, but we're not reliant on the open and close the way candlesticks are, the way they form the dark and open body. So it doesn't really matter. All we're concerned about are the ranges from top to bottom. So we're looking for that 2-bar outside day pattern, and as we scan here, we see that we have it right here. Here's a outside day where both the bars are touching the 50-period simple moving average. And guess what? The very next 2-bar pattern here follows doing the same thing. We have another outside day, and they're touching. So this is telling us that we have a move that's going to be a high probability chance that we're going to have a big move here in the euro dollar. And this was back in May. As you can see, in the next couple of months, or next month actually, euro dollar fell out of bed down 800 pips. Just by, once again, not worrying about any type of conventional wisdom here that we usually use by some Gann lines or some type of indicator or some trading guru that says there's bad news coming out for the euro dollar. We didn't care about that. Keep it simple. Leave those things to the wayside. Only give so much attention to that. You should be giving 80% of your attention to what you see right in front of you. That's on the screen. Now, here's how we can fine-tune this, because I know you're probably saying, well, okay, I see this pattern, but which way is it going to go? How do I know which way it's going to go? Well, if the high or low of the outside bar, remember that's the second bar in the pattern, is exceeded on the next bar, then the trend will most likely continue in that direction. Okay, so that's your clue as to which direction it most likely will go. Once again, not guaranteed, but this is a strong, strong clue that if that second bar in the outside pattern is exceeded, either it's high or low, that's the direction it will most likely go. Let's look back at those two examples once again to see how that works. Here's the original example we showed you in the British pound. Here's the two-bar pattern right here. All right. Now here's the one we're focusing on, the outside day. All right. Now what we want to see is either the top exceeded or the bottom exceeded of this pattern. Okay, and that will tell us most likely which direction it's going to go. But it has to happen on the next bar. We have to see this momentum carry through on the next bar. So if we look what the next daily bar was in the British pound, well, the top bar was violated. In other words, we went higher and we exceeded the range of the top. Doesn't matter where we closed, doesn't matter if we closed above or below, if we kept going, all that matters is that that was exceeded first. So this is our clue saying most likely there's going to be a high probability that we have an uptrend in the British pound. And there it is. Okay? Let's look at the other example we had in the euro dollar. Once again, we have the two-bar pattern here. We're touching the 50-period simple moving average. Now, which is going to be exceeded first, either the top or the low? Well, the top wasn't exceeded, and neither was the bottom. So, actually, there's no clue here. So we have no fine-tuning as to which direction. So you would probably just say, you know what, I'll just wait and see what happens, but I'm not going to try and take advantage of anything. But guess what? We have another outside bar here, two-bar pattern, another two-bar pattern. So we ask ourselves, well, let's see if we exceeded either the high or low of this one, because they meet all the requirements. We're still touching the 50 period. So let's see which is exceeded first, the top or the bottom. And on the very next bar, the bottom was. So there's your clue. There's your clue saying most likely we're going to have a strong, high probability move to the downside. Now, how could we use this? Well, you could say, well, if I'm currently long the euro dollar, I'm not saying that this is a trading strategy or a methodology, but I could move my stop up. Or if I were possibly short the euro dollar and I was thinking of covering, well, if there's a chance for a nice move to the downside, as there was, maybe I don't want to cover yet. Maybe I want to just stay in the trade a little bit longer, because the odds are telling me, because we had the two-bar pattern, it was touching the 50-period simple moving average, and the low of the outside bar was exceeded, well, most likely we're going to go lower. So you see how simple this is. Remember, I said my goal is to teach you how to trade with the specialist edge. The specialist edge is rooted in simplicity. The reason why most traders lose is because they overcomplicate their trading. This is extremely simple, but look how powerful this is. All right, let's look at some other examples now in multiple time frames. This just doesn't work on daily bars. This can work on intraday bars. It can work on monthly bars, and I'll show you some examples. But remember, this is not going to happen every day. We have to have that qualification where we have the outside bar exceeding the previous bar, and one of those two bars in the pattern has to touch the 50-period simple moving average. All right, here's a 60-minute chart, an hourly chart of the Canadian dollar. This was just last week. Okay, this was on the 23rd. And as we see here, first looking is we have a kind of a sideways move on the 50-period simple moving average. We're looking for that outside bar, and the two-bar pattern, one of those bars should touch the 50-period simple moving average. As we see here, we have an outside bar that touches, okay? So, guess what? The very next bar exceeded the low. So that's your clue right there telling you that on an hourly basis, the Canadian dollar is probably going lower. But then we continue to have these outside days. Here's another one. Did we exceed either the high or low? Maybe it was going to signal a change in trend. Maybe we were going to go higher. No, the very next bar we didn't do anything. But here's another one. Here's another outside bar. And we're touching, one of the two bars is touching the 50-period simple moving average. And very so slightly, once again, we exceeded the low. So here's another clue, your second clue telling us we're going lower. And then guess what? Here is another outside bar, two-bar pattern. And this low was exceeded on the very next low. And guess what? Here is another one. So you see all the clues, once again on an hourly basis, where the market, not an outside source, but the market on an hourly time frame is telling you there is a huge chance here that we're going to be going lower in the Canadian dollar. And then we finally fell out of bed. Now, it's not a ton of pips here. It's only 60 pips that we initially went down right away. But still, you could have had multiple lots, multiple contracts, and at least you're on the right side. And so this is what matters. We're just trying to be on the right side of the market. Here's a daily bar of the Canadian dollar now. We just looked at the hourly bar. Let's look at a daily bar going back to May all the way up to the mid-September. And as we see here, we have the 50-period simple moving average, and we just have the normal open, high, low, close daily bars. All right? So we're looking for that two-bar pattern. We see there's one right here. There's an outside bar, and we're touching, both bars are touching the 50-period simple moving average. So which of the high or low was exceeded first? Well, obviously the high was exceeded first, so there's your clue that the Canadian dollar was going higher in May. And guess what? The trend went up for another 400 pips, okay? So you could have been looking for a buy signal because you knew that most likely we're going to be going higher. All right, so then the trend ended. We've come down again, and we touch the 50-period simple moving average. Here's an outside bar, all right? So we were looking for a clue to tell us which direction it's most likely going to go. But guess what? The very next bar didn't exceed either the high or the low. So we negate this signal. We negate this technique. We wait a couple of weeks later, and here's the outside bar formation. Both bars are touching. So we look to see which high or low is going to be exceeded first. Obviously, the low was exceeded in the outside bar. So there was our clue that we were going lower, 500 pips to the downside. Doesn't get any simpler than that. Now, if you want to look at a monthly chart, these are all examples in the Canadian dollar. We looked at an hourly chart, a daily chart. Now, let's look at a monthly chart going all the way back to 2010. Okay, here's the 50-period simple moving average. We're not concerned with other indicators. We're not concerned with other time periods of the moving averages. Just the 50-period. That's all you have to have on your screen. And we're looking for that two-bar pattern. Once again, here it is. Here's the outside day, and both bars are touching the 50-period. So this is your clue that a trend change is coming. And which of the high or low of that outside bar was exceeded first? Obviously, the low was on the very next monthly bar. So that was your clue that the trend was either going to start to go lower or was going to continue to go lower. Okay? So all during that 1,300 pips to the downside, you could have been just looking for shorting signals, whatever your strategy is. And this is what we teach in market at Specialist Trading. We teach you the strategies to look for once we've discerned what the current trend is. All right, let's look at a different currency pair. Here's a dollar, or I should say, a hourly chart of the dollar yen. Okay, as you can see, we had a real nice move to the upside. How could we have seen that that trend change was going to happen? Well, we look back in hindsight, and we see here, here's your outside day. There were no outside days here, but in this particular outside two-bar pattern, they were touching the 50-period simple moving average, and the top bar was exceeded first, or the top of the range was exceeded. So that was your clue that we were going higher, 125 pips in a nice range, trend range to the upside. If we look at a weekly chart of the Australian dollar going back to 2010, all right, a lot of people will say, well, it's kind of, moves up and then it kind of pauses and moves up and pauses. Well, how could we have seen in advance before the trend started? Look at all these different spots here going back on a weekly chart. As you can see, these are all outside two-bar patterns, and they're all touching the 50-period simple moving average. All right, all we have to do is see which of the outside bar, the high or the low, was exceeded first. As you can see here, the high was exceeded first, so you had a nice trend move to the upside, roughly lasted about 1,500 pips. Then the trend stopped, and then we get another clue right here again. Which was exceeded first, the high or low of that two-bar pattern? The high was. So that's your clue that most likely you're having a trend move to the upside. And we went up 2,000 pips. So all during that up move, you could have been looking for signals to go long. You would not have tried to short anything, once again, because the market was telling us it most likely wants to go higher. So remember, we're not going to pick tops and bottoms. That's a recipe for disaster. And then lastly, the trend changed on that particular up move, and guess what? We had another outside day right here. Which was exceeded first, the high or the low? The low was, so this was telling us that most likely we'd have a move to the downside. Okay, that's a weekly chart. Let's look at a daily chart of the euro now. Okay, this is going back once again to August, September. And as we see here, we have an outside bar in August, the two-bar pattern. The second bar is touching the 50-period simple moving average. Now, it wouldn't matter if it was the first or second or both, just as long as one of them is touching. And now, once we see that outside bar pattern, we wait to see which is exceeded first, the high or the low of that second bar. Well, obviously, the high was. As you can see, we're not interested whether it's exceeded and closes above or where it closes. All we want to make sure is that on the very next bar, either the high or low is exceeded. That's our trigger that most likely we're getting an uptrend. As you can see, 750 pips in the next month or so to the upside, all from that simple clue. Now, coming into this, you could see we were really in a rangy market. We're going higher, lower, and someone could say, well, Steve, this is an outside bar here too. We're touching the 50-period simple moving average. It totally, is higher than the range of the previous bar. Why didn't you use this? Well, because we look for our trigger clue. Either the high or the low must be exceeded on the next bar, and nothing was exceeded, so we negate that and we look for another setup here. Okay? So coming into this, we were just in a kind of rangy high, low, but this was your clue that we're going to get a nice move to the upside, most likely, and it happened. Here's a 1,000 tick bar chart of the euro yen. Okay, you want to day trade the currency pairs? That's fine. Here's the tick bar chart. As we see, we had a very nice run up in the euro yen. Someone here could have said, well, maybe it's going to end, and I think we'll be getting out. But probably the rally is over. But looking back, we see that here's a 50-period simple moving average. Here's an outside bar. Here's a 2-bar pattern. They're both touching the 50-period simple moving average. Either the high or low must be exceeded on the next 1,000 tick bar chart, and the high was. So that was your clue that if you were long the euro yen on an intraday basis, you may want to stay long because we're most likely going to have an uptrend continue, and let's look what happened, 175 pips in the next day or so. Here's a weekly chart of the euro yen. Okay, now this is your one clue for this presentation. This is a current weekly chart up until last week. As we see here, we have the 50-period simple moving average, okay? We're looking for that 2-bar pattern, and in November, in the last couple of weeks of November, guess what? The euro yen on a weekly basis gave that outside day pattern, and both of the bars in the pattern were touching the 50-period simple moving average. So this is a valid clue here, and then we waited for this past week to see if the top or the bottom was exceeded, and this is the action that happened last week. It was easily exceeded, so what does that tell you? That tells us that most likely, not predictable, but not guaranteed, and not written in stone, but most likely the euro yen on a weekly basis is going to be moving higher. Okay? So this may be something you want to watch if you're currently an investor, if you like to trade off of weekly bars. Remember, you have to take each trend for its particular time frame. So if you can see a weekly bar in the euro yen telling you to go long, and you can see a 5-minute chart of the euro yen telling you to go short. Just trade the time frame and look for the trend in the time frame in which you're trading. All right. Don't try to use a higher time frame to judge the trend of the lower time frame. It doesn't work that way. This once again is something that I know a lot of people rely on. A lot of teachers teach this. I, in my 35 years, have found no consistency in trading this way. I know a lot of our members and a lot of my students swear by this. Personally, I've never found a higher time frame having any consistency to judge the trend of the lower time frame. So I personally teach my students just trade the time frame you're looking at in the chart. If you see a weekly chart, such as we're seeing right here, giving you a clue to a high probability upward trend, then that's all you're concerned about. We're not concerned about what it looks like on a monthly chart or a daily bar. It doesn't matter. Okay? Now, if you want to only trade daily bars, well, then you have to look for a trend change pattern here in a daily time frame. If there is nothing, well, then you have no clue. Okay? So we only look at the time frame we're viewing and we want to trade. We don't concern ourselves with a higher time frame confirming a lower time frame. Once again, I've been trading for 35 years. It will work sometimes until it doesn't work. So there's no consistency in that. At specialist trading, as you've just seen here, we try to make things very cut and dry. As you can see, there's no discrepancy here where we're not wondering, well, maybe it's an outside bar pattern, maybe it's not. No, it's cut and dry. You know whether you have a 2-bar outside day pattern or not. And you know whether the top or the bottom of that second bar is going to be exceeded. You see, there's no room for subjectivity the way there is with support and resistance, the way there is with higher time frames and lower time frames. We want to keep things extremely simple. We don't want there to be any room, whereas one student will say, well, I see a uptrend signal, and another one will say, no, that's a downtrend signal. We don't want subjectivity in any of our trading. We want everyone to see the exact same thing. That's why we keep them very simple and very cut and dry. So anyway, there's your clue for a weekly chart of the euro yen. Now, I know right before this presentation, one of my students emailed me. I haven't had a chance to look at the chart, but they said there may be a trend change set up on a daily bar chart of the euro dollar. So I invite you to look at that. I haven't looked at that myself yet, but there may be one of these patterns here on the euro dollar as well, but on a daily time frame. All right, so let's recap. This is a simple but high probability technique for spotting trend changes in the Forex markets. We're only looking to spot trend changes. We're not looking to go long or short with one of these things. We're just looking to get a high probability so that we're in sync with the market. Remember, the only indicators you need are a 50-period simple moving average and an outside day bar pattern. All right, an outside day bar pattern is just 2 bars, and the second bar, its range totally exceeds the range, the top and bottom of the bar before it, and that's it. Okay? Remember, my goal is to teach you how to trade with a specialist edge. The specialist edge is rooted in simplicity. You see how simple this is. All of these trend changes, all of these examples I just showed you were without the help of looking at any economic news that came out, without any trade rooms or chat rooms. We don't have them at specialist trading. We don't believe them. We just give you sound, solid methodologies and trading techniques that really take your trading to the next level. Points to remember. All right, I know a lot of you, your eyes are lighting up going, oh my gosh, this is great. I'm going to use this. I'm going to start trading it. Remember, this is not a complete strategy. It's used as a directional tool to get you in sync with the current direction of the market. So trade in the direction of the trend. All right, so that's why you want to use it, so that you know where the trend is and you'll trade in that direction. Please remember, you can apply this to any direction in any time frame. It's not just for daily bars going up. You can use it for down trends. You can use it for tick charts, for daily bar charts, weekly charts, as we just showed you. Now, I just want to take a second here to talk a little about some of the courses we offer. Here's probably one of our most prolific courses. This is strategy number 4, which follows the same type of philosophy, only trading in sync with the trend. Now, this is a great one of our most prolific strategies that we teach and our members use at Specialist Trading. This is just a sample of the strategies we use. If you decide to become a member of Specialist Trading, you'll get immediate online course access, detailed instructions. This comes with 4 videos. I tell you exactly where to enter, where to exit, and where to place your stops. One of the best things is, for all of our members, for the first year, we provide you with daily signal alerts. So we tell you where to get in, where to get out the night before on using daily bar charts. Okay. This also comes with 1 year of weekly trading lessons. Each week I give a trading lesson, very similar to what I gave today, different tips and techniques to elevate your trading. You can get a PDF of all the rules so you can print it out and study at your own leisure, and you also get my personal email address where you can contact me anytime, virtually anytime, ask me any questions you'd like. Now, this course usually runs for $695, but for all the FX Street attendees today, we're reducing it by $200 down to $495. Okay, this is a great offer here. Even at $695, it's a great offer, but for a limited time only, for all the people that attended today, just let me show you a few seconds here of some signals that were generated in the past month using this strategy. Once again, remember, all of our members will receive the night before all the entries, exits, and stops for this particular strategy. Here was a signal we had in the Canadian dollar on the 18th to go long of October. Here are the signals we had in the British pound going long in October and then going short in November. And then lastly, here was the signal we had in the euro yen to go long on the 14th on a daily time frame. Remember, these are all signals provided for our members. As you can see here, had you taken each one of these signals, you would have paid for the course many times over. You could have bought all your Christmas presents with this and given them to all your friends. We're reducing this from $695 down to $495 for all the members. Now, I know a lot of people were asking in the beginning, where exactly is that link which you provided so that I can find out more about you on FX Street? Well, here's the link in blue. That's the main link. We've abbreviated it on the very bottom there in yellow, http://bit.ly/06mgvo. Okay, so you can copy that down real quickly, and that will take you to the microsite that FX Street has provided for us. It gives you more information about myself, gives you more information about any of the strategies that we promote and teach, and I'll just give you a little bit of background about what I do at Specialist Trading and my philosophy for trading. Okay, so I hope you've all copied that down, because once again, once you go to that bottom link there on the bottom, it'll take you to this microsite here that FX Street has so kindly provided for us. Okay, now, as promised, we're at the end of the presentation. If you have any questions, let me open up the question in the answer box here so I can make sure and answer anything. And I just want to make sure I'm receiving everything okay, so let me open up that box. Just one last thing. If you have any questions, if we ran out of time, if you're concerned with purchasing our strategy, remember you can only have that limited offer for a couple of days. You can go to our sister site, which takes care of that. We sell individual strategies. That's protraderstrategies.com. If you have any questions, you can contact our VP of Operations. That's Brett Marsh at brettm@specialisttrading.com. Or you can give us a call at area code 310-844-7220. Okay, thank you. You see the chat box. Let's see. Steve, I have followed your webinar. The 50-period simple moving average strategy is great and worked every time. But one question arises. Why all the PA and the outside bars and the most patterns conjunct at the 50-period simple moving average? Any universal law? Well, it's funny. When I first started looking at this technique, this was years ago, what happens is that, if you want to explain this in terms of, statistical or just very scientific reference, you can use the phrase the reversion to the mean. In other words, the 50-period moving average is basically the average of where the price should be, and many times price will revert there and then signal that it wants to either switch directions or go back in the previous direction. So this is basically why the 50-period simple moving average. We see so many times that price will touch that and then either reverse direction or continue in the same direction. Now the only trouble is it's very difficult to know what it's going to do once it touches that. So this is a great technique with this outside bar. The outside bar is just really showing you volatility in the market and indecision. So this is an indecision pattern and volatility pattern. And usually that means that when you see indecision and volatility, a trend usually follows. So we have to ask ourselves, well, which way is it going to go? And the great technique which was taught to me is that whichever bar is exceeded first, either at the top of the range or the bottom of the range of the second bar, that will give you a clue most likely as to the short-term direction. So it's just really a reversion to the mean. The market then has to decide what are we going to do. Are we going to continue going higher or lower? And then it gives us the clue. So I hope that answers your question. Second question here. Let me see. Boyke says, I like it. I take it with candles to exceed the high and low. Yes. In other words, I know a lot of Forex traders love candles. The only reason we use candles is for the bodies, because the bodies tell us, they give us some type of clue or direction of reversals usually. We're not interested in the body, so therefore it doesn't matter if you use candles. You can still use candles. All we're interested in is the outside high and low ranges. And so you can see that high and low range either in a candle bar or you can see it on an open, high, low, close. It does not matter. But we're not making any reference to whether we engulfed something, where the open and close was for the previous bar or where the open and close was for this bar. Okay? So that's why I don't want to complicate too many things, because so many students make reference to the candlesticks and say, well, is it an engulfing pattern? Is it a doji? It doesn't matter. All we are concerned about are the high range and the low range of the second bar of that pattern. Okay? See if there are any more questions here. If you enter on the following high bar, where would you put your stop? Okay, that's a great question, Frank. Remember I said about 4 slides ago, points to remember. This is not a strategy, okay? Therefore, if it's not a strategy, there's no reason to enter, because you only enter on a strategy or some type of trading methodology. This is a directional tool. So once you see that we've exceeded the high of that range bar, the low of that bar, then you say, I know what I have a really high probability degree of knowing where the trend is going to go. And now you start looking for signals in the direction of that trend. Now, I know a lot of students will say, well, I don't know how to look for signals. I don't have a strategy. That's what we provide at Specialist Trading. I provide you with signals in order to find those high probability trades within the trend. And as I just showed you with the strategy, what we have with strategy number 4, those signals were all taken off of trading with the trend. Okay? So remember, this is not a strategy. That's why I made a big point about saying that. This is just a directional tool. There's no reason why you would enter anything, because you don't enter on directional tools. You just use them to find out where you're going to be trading either long or short. Okay? Any more questions here? If second bar is just short of 5 pips of outside bar, can discount on the second bar? In other words, I believe you're asking if it doesn't meet all the qualifications, just maybe 5 bars or so. Yes, once again, these things are written in stone. I would say just track it for a while and see how well that works. I believe you're just asking that if all the rules and requirements are not met exactly, can we kind of bend it a little bit off by 1 to 5 pips? Yeah, I wouldn't persuade anyone, no, it has to be perfect, but I would watch it to see how well it does. Usually when I use this, it has to be perfect, but it's up to you. This is just a great tool. Any more questions? Do signals give stops and targets? Yes. Once again, when we're talking about signals, we're not talking about this tool we just showed you. We're talking about the signals that we provide at Specialist Trading. Every strategy we give you provides stops. It provides you with targets. It provides you with information on when to move your stop to unchanged. We give basically anywhere from 3 to 4 different ways to use stops. You can use aggressive stops. You can use conservative stops. We give you about 3 or 4 different ways to exit. We have a standard generic exit point. We show you ways in which to use that, whereas you can stay in the trade much longer if you like to try and squeeze as much profit as possible. This is all part of the things I've learned in 35 years. And we wrap them up and accumulate them into strategies so that you can learn and start trading within the next couple of weeks to a month. Okay? They're extremely simple. All of my strategies have no more than 5, 6 rules at the top. And really the rules are basically things like what we just showed you today. Very simple and very easy to, as I stated, my philosophy is to keep things as simple as possible. I started out this presentation by saying the reason why most traders lose is because they overcomplicate things. I really feel that getting involved in too many indicators, getting involved in too much fundamental news, trying to decipher and waiting for economic reports to come out, getting involved in too many chat rooms or trading rooms really hinders your trading. For some reason, people think that that's what's going to make them successful. But ask yourself, has it made your trading any more successful? I did the same thing. I'm speaking from experience because I did the same thing when I first started. So basically, my trading turned around and started to become consistent right when I started to simplify my trading. As my mentor taught me, and what he said to me on the very first day he started teaching me, he said, Steve, it's the easiest thing in the world to complicate your trading. Anyone can do that, whether you've been trading for 1 week or 20 years. Anyone can overcomplicate your trading. It doesn't take much character to do that. It's the most difficult thing in the world to simplify your trade. That's where you really separate the traders from each other. A trader that can keep things simple is the one that most likely is trading 30, 40, 50 years down the road. So that's what my goal is, to teach you how to simplify your trading and how to rely on it. My mentors were traders on the floor. I can't give out their names, but I've talked about them before. They were traders on the floor who saw how much I was struggling and probably trading like a great deal of other traders, just having difficulty making ends meet. I think we're just about at the end of the presentation. Once again, here's the information. If you have any more questions, please feel free to email us at brettm@specialisttrading.com or give us a call at 310-844-7220. I thank you so much for attending today. Remember, if you want to take advantage of that great special we have on strategy number 4, be sure to contact us. It only is going to last for a day or so. And I thank all the people at FX Street for inviting me and giving me the opportunity to speak. Thank you so much. We'll see you next time. Bye-bye.